Do you know your company's financials without looking? Or are you running your business by gut feeling and bank balance alone? If you're like many business owners who don't look at their numbers regularly, it's like flying blind. Here's a scary fact. 82% of businesses that fail cite cash flow as the problem and the reason why they're closing. Not because their idea was bad or because they had problems in their product, but because they didn't see the warning signs in their numbers before it was too late. Today, we're going to go through the 6 most crucial numbers you need to track as a business owner. These aren't complicated metrics that require an MBA. They're simple numbers to help you determine if you're growing, stable, or in trouble. And I promise, once you start tracking these, you'll start to sleep better at night. But first, if you're tired of financial anxiety and want to gain control of your business, hit that subscribe and notification bell right now. Every week, we're breaking down one financial concept that can help you turn your business from stressful to successful. Okay, let's be honest about why most of us don't track our numbers regularly. It's not because we don't care, it's because we're buried in the day-to-day operations, serving customers, managing employees, putting out fires. Also, there's probably a little part of us that thinks if I start checking the numbers, I'm not gonna like what I see. We've all been there. For most of us, if we check our bank account and as long as it's not zero, we think we're fine. Then one surprise bill comes around or a customer pays late and it's a big wake-up call. The truth is, running a business without looking at your metrics regularly is like driving across country without a gas gauge, no speedometer, and no map. Sure, you might be able to reach your destination, but the odds are probably against you. Let's start with the most basic number, annual revenue. But not just your total. What also matters is the pattern in this number. You should know, are you growing or shrinking compared to last year? Is your revenue consistent or wildly fluctuating from month to month? Which products or services generate the most revenue for your business? And lastly, what is the makeup of the revenue per client? Do you have a few clients that make up the majority of your business? We started working with a company that was super proud of hitting $2 million in revenue. We learned that the majority of that business came just in one quarter of the year, and they didn't have plans for the other 9 months. The rest of the year, they were burning cash and didn't have a plan. If you don't know the makeup of your customers or products and services behind your revenue, you might be focusing on areas of sales and marketing that don't produce any profit. It's important to understand your revenue on a deeper level. It's great to talk about your revenue as a headline number, but if you don't know the details, you could be setting yourself up for failure or growing unprofitably in the future. Next, let's talk about gross profit margin. Your gross profit margin tells you how much profit you earn from each sale after paying for those costs that are directly related to providing that service or delivering that good. For example, if you sell a t-shirt for $100 and it costs you $60 in materials and direct labor to sell it, your gross profit is $40 and your gross profit margin is 40%. Why does this matter? Well, because a business with 15% gross profit margins has to work a heck of a lot harder and sell a heck of a lot more than a business with 40% gross profit margins to make the same profit. Low margins may be great for growth, but it leaves no room for error. Quick tip, calculate your gross profit margin on your top 3 products or services. Then compare this gross profit to the gross profit of the total business and determine if it makes sense to continue selling those other products or services. By the way, stick around to the end of this video where I'll show you some tips and tricks to get these numbers automatically without spending nights and weekends in spreadsheets. The next number that's really important is your monthly fixed costs. This is also referred to as the monthly nut. Your monthly nut is the amount of money you need to collect each month or revenue you need to generate just to cover the fixed costs of your business. These are things such as salaries and payroll, rent, insurance, software and subscriptions, loan payments, utilities, and any other expenses you pay regardless of whether you make a sale or not. Knowing this number is crucial because it's your break-even point. How much you need to sell just to cover your overhead. We work with a law firm that was stressed about making ends meet each month as they focused on growing. When we calculated their monthly nut between salaries, rent, advertising, and overhead, it was almost $100,000. Knowing this number helped them determine how many hours they need to bill out each month and how much they need to collect from their clients each month. Suddenly, their plan on execution became super clear. Now here's a reality check. Many business owners underestimate their fixed costs by as much as 30%. They forget about bills that are paid once a year, such as insurance premiums, some software subscriptions, or other things that need to be planned for in advance when calculating your monthly nut. Be thorough and careful when calculating this number. I recommend using the last 12 months of bank balances to make sure you don't miss any upcoming payments and get caught. Number 4, your net cash balance. This number tells you how much extra cash you have after paying down all of your liabilities, and it gives you a picture of how much you can invest or take out of the business. It isn't just your bank balance, it's your true liquidity. To calculate it, take your total cash minus any lines of credit or long-term loans. This number is like your business's oxygen supply. When it gets low, everything gets harder, and growing takes a lot more work. One of the real estate companies we work with was trying to determine if they could buy another building. They had $1 million in cash in the bank and thought they were good. However, after considering the value of the building and if they bought this building, they would fall further into that negative cash balance and really struggle making debt payments in the future. By doing this analysis, they paused on their expansion efforts, paid down their debt, and recalibrated the business so they could generate cash flow regularly before focusing on growing again. They got lean and mean. Now, continuing with cash, another metric to focus on with this balance is your cash flow rate, or if you're growing, you might be in a burn situation. Your cash flow shows whether you're generating or consuming cash on a monthly basis. 1 month doesn't tell a tale, so we recommend calculating your burn rate as an average of the past 3 or 6 months and considering what the plans are going forward. If you think you're going to generate positive cash flow in the future, that's great. Now the question is, what do you plan to do with that cash? Are you going to reinvest, or are you going to take it out as a distribution? Now, if your cash flow is negative, that means you're burning money and you need to start looking at your bank balance. Many businesses are profitable on paper, but still have negative cash flow because they're investing in new inventory, acquiring another business, waiting on slow paying customers, buying equipment or new buildings, paying down debt, or investing in other ways to expand their business. Consistently negative cash flow isn't always bad if it's funding growth, but you need to know your burn rate so you don't run out of runway. So what is runway? Well, that's number 6 on our list. Your runway is simply how much time you have before your business runs out of cash. Calculate it by dividing your net cash balance by your monthly cash burn rate. If you have $1 million of net cash and you're burning $250,000 a month, you have 4 months of runway. Now, if you're generating positive cash flow, think of your runway as your safety buffer. How many months could your business survive if revenue suddenly dropped? This metric saved many businesses during the pandemic. As the world shut down and demand for many businesses dropped, companies had to pivot and understand their net cash balance to figure out how they could survive. We worked with a startup whose clients were impacted by the pandemic shutdowns. Because they knew their cash burn rate and their runway, they were able to immediately pivot, make adjustments to their cost structure, and extend their runway long enough to see demand return, and now their business is thriving. Most businesses should aim for a runway of at least 6 months, with 12 or more months being ideal. Or if they're still trying to find product market fit, need even more. Now you might be thinking, this all makes sense, but how do I track these numbers without it becoming a full-time job? This is where having the right accounting partner becomes important. Most business owners we meet have either no financial reporting beyond basic tax documents, or they receive their financial documents after the quarter or the year is already done when they're no longer relevant. Some of our clients receive complex financials that they don't understand. What growing businesses need is simple, actionable financial insights consistently. Now, whether you work with us or you work with another bookkeeper, it's important to make sure your books are kept up regularly and they show the financial position of the business and the results of your operations in a way that's easy to understand and can give you actionable advice to make quick decisions. Now, if you're looking for more numbers to track, there's a lot more to come on our channel. If you want a little taste of the numbers that can help you even further, here are a few. Customer acquisition cost and lifetime value, net revenue retention, sales pipeline conversion rates, inventory turnover rates, burn ratio, and net profit margin. If this video helped you understand what numbers you should be tracking, please hit that like and subscribe button. It really helps us share these insights with business owners who are looking to scale. In the comments, let me know which of the 6 metrics you're looking forward to tracking next month. Lastly, if you're looking to stop flying blind and want professional help to track the metrics of your business, reach out to us at Proseer. The link is in the description. We specialize in giving business owners like you clarity and confidence through simple financial intelligence. Thanks for watching, and we'll see you in the next video.